gain or loss, Hudson Company's actuary has provided the following information concerning the company's defined benefit pension plan at the end of 2019. Fair value of plan assets, $350. Actual projected benefit obligation, $360. Expected projected benefit obligation, $424. The average remaining service life of employees, 10 years. The difference between the actual and expected projected benefit obligation first occurred in 2018. Compute the amount of gain or loss for Hudson's pension plan at the beginning of 2019, assuming that Hudson uses the corridor approach. And so let's fill in this number first, and then we'll come back to the gain or loss. And so to figure out the gain or loss, we're going to take the expected projected benefit minus the actual, and that'll give us a $64,000, and it's a gain because we expected the obligation to be greater than the actual benefit was. And so here we'll switch this to gain at the beginning of 2019 of $64,000. Then compute the amount of net gain or loss to include in Hudson's pension expense for 2019. Indicate whether it's an addition to or subtraction from pension expense. And so this is really just continuing what we just did. So it's still a gain, a net gain recognized in 2019, which will be subtracted from, so I'll get rid of this added to, subtracted from pension expense. And we have to calculate what that is going to be. And they told us using the corridor approach. And the reason for that is because many companies don't want to immediately recognize the entire gain or loss, because then there's going to be significant fluctuations in the pension expense. And so they use the corridor approach, which allows them to amortize the expense over time. And so we will do that. And if you recall from the text, the minimum corridor amortization, I'll just type it over here, would be equal to the cumulative net gain or loss at the beginning of year minus the corridor at the beginning of year, all divided by the average remaining service period for the active employees expected to receive the benefits under this plan. I'm not going to type all that out. And so now we have this, but what exactly is, how do we define corridor? And so corridor is defined as the 10% of the greater of the beginning of the year projected benefit obligation or the beginning of year fair value of the plan assets. And so now that we've defined that, we can add that here into our formula bar. So I'm going to use a set of parentheses. And our cumulative net gain, we just calculated as the 64,000 minus, and let's do another set of parentheses, 0.1 or 10% times, and we said corridor is the greater of the beginning of year projected benefit obligation or beginning of year fair value. And so if we come over here, the fair value is 350 and the beginning of year projected benefit obligation is 360. So we would use that 360, close parentheses again, divided by the average remaining life of 10 years, and we get 2,800. And so we would recognize that 2,800 as a net gain, which we would subtract from the pension expense for this year. The last part of the question is, if the Hudson Company is using IFRS, how would the gain or loss be treated? And so we have Hudson would immediately recognize the gain or loss as other comprehensive income. Hudson would amortize the gain or loss using the corridor approach. Hudson would use a systematic and rational approach that results in the slower amortization than the corridor approach. Hudson would immediately recognize the gain or loss in the net income in the period it occurs. And so the answer to this is A. Hudson would immediately recognize the gain or loss as other comprehensive income. And that is different, obviously, than GAAP, where we're using this amortization. And that it used to be the same. And then the IAS 19 was amended. And so it no longer does align with GAAP, obviously.